Investing in US small cap companies has been a winning factor for over 50 years, particularly investing in small cap value. And this probably doesn't feel right if you're familiar with the past decade and what's gone on in the market. Hasn't large cap absolutely dominated? It has. But in this video, we're going to zoom way out to see how things have played out over multiple decades. We'll dive deep into the historical results, and I'll give my 2 cents on some other factor investing battles that have happened over many years. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please overwhelm that like button to the point that it changes colors. Subscribe if you haven't already, and drop me a comment down below with anything that comes to mind as you watch this video. And a quick word from no sponsor boy here, and I'd love to keep it that way. Consider using my links in the description below if you think that they'll add value for you. You'll find my link to join Seeking Alpha Premium if you think that'll add value for you and it'll help you save money. And I also have my Amazon storefront with some of my favorite books. I'm only going to put stuff in these videos and talk about things that I actually enjoy using. And I don't mention this one very often, but consider becoming a channel member if you think that the perks are juicy enough. Details down in the description. You know what time it is. Let's grow. Background. If you've watched a few of my videos and you know about my portfolio mix, it's likely clear that I prefer large cap stocks as a rule of thumb. This video topic may be confusing coming from me. It would be like a lifetime basketball fan that doesn't care for football making a video about how much better football is. But the historical evidence favors small cap value by a lot. Like a lot. Like a portfolio visualizer almost got an email about a glitch that I found a lot. I love studying factor investing quite a bit, and I've baked quite a few of the key factors into the HODL factory, my individual stocks that I run, that have outperformed the S&P 500 by a significant amount. Factor investing is a strategy that looks for attributes that produce higher returns. There are a ton of them, but we will be diving deeper into the size factor in this video. We'll refer to a quality article I found on the topic, and we'll also look it up together by conducting our own backtest with over 50 years of data. The research favors small cap. Let's touch on the article before we jump over to Portfolio Visualizer. And the first thing we'll see out here is that the article is titled, "Is the Small Cap Premium Dead?" I promise you I objectively looked for small cap versus large cap performance, but this article gets into some good stuff. I just got a giggle and I could just feel people being like, nice research, Teeps. And you can see here it's by Ben Carlson, and credit to Ask the Compound. These two dudes, it was on a podcast that they were fielding questions. So I just wanted to give some credit for sort of the origins of this. And someone sort of asked, about the small cap advantage. And I want to get into this answer because it's very interesting. We'll start here. The returns from 1926 to 2021 had small cap outperforming large cap 11.99% to 10.35. That's almost 100 years of a major outperformance. Like when you compound this even over 10 years, it's like what I beat the market by roughly, and it's hundreds of thousands just for my little world. So this is a big difference. But they go on to say that basically all of the premium came in one 9-year window between 1975 and 1983. And we'll dive deeper into this when we go out to Portfolio Visualizer. So we're gonna start one at 1984 after pulling all the data. So we'll get there because during that time, small caps were up more than 1,400%. They outperformed large caps 35.3 to 15.7 per year. So the theory is if you take away the outlier, the rest will become much closer. And then the article does exactly what popped into my head, to be honest, by mentioning, okay, fair enough. However, what if we excluded 2016 through 2024? Then all of a sudden the large cap performance would be diminished and small caps would look much better historically. Their point here is if you take out the monster run of anything, of course the other one's going to look a lot better over the rest of the years. That's like those stats you always see, you know, if you miss the top 20 days in the market over the last 10 years, you lose like over half your returns. I don't have it on top of my head, but it's wild what missing just a few days does. It's sort of that kind of logic, just over a prolonged bull run for each of the assets. So with that point in mind on both sides, the next step is to look at the historical returns. And we have the Russell 2000, which is a small cap index. It goes back to 1979. And since 1979, it's up 10.9% per year to the S&P 500's 12%. So it falls short. But then the S&P 600, which is a better index, I've read a lot of books about this, and this is the exact reason right here, it excludes the many unprofitable stocks that are included in the Russell 2000. It only goes back to 1995, and since then, the S&P 600 and the S&P 500 are tied at 10.7% per year. That's pretty good considering the last few years have favored the S&P 500 so much, as it mentioned at the top. And then it goes on to say Vanguard has a small cap index fund that goes all the way back to 1962. Since 1962 has returned 10.7% per year to the S&P 500's 10.2. And then there's a DFA small cap value fund that goes back to 1993, so it's a little newer, and you can see that it returned 11.3% per year to 10.3, so quite an outperformance, including the recent bull run of large cap. And then this graph right here, and we're going to dive more into the recent stuff when we get out to Seeking Alpha, but it just goes on to say over the last decade, small cap has fallen well short of large cap, which I'm sure most are aware of. It's up 120% to 237. It's quite impressive, some of the stats that we just talked about, considering large cap has just dominated, but even through that all, a lot of the scenarios are about tied when you pull in more data. And I don't want to get too hung up on this article because we're going to get into much more comprehensive data for asset classes out in Portfolio Visualizer here in a minute. So the last thing I'll show is just this large cap versus small cap cycles. This is a bit scary, and this sort of argues in favor of small cap, in my opinion, right now. So if you look during this 6-year stretch, the small cap only returned 120% to the S&P 500's 248. But then when you flip the next year and you look at a 13-year stretch, the small caps from 2001 through 2013 were 288 up, 263 the large cap. That is wild right there. But then again, literally 1 year later, and this gets into the current 11-year run, we're at 133 for small cap and 243 for large cap. Like, you want to talk about reversion to the mean? You should print this and put it on your wall, because we all get caught up in the moment with like growth stocks right now, and it's always the new thing. But wow, this is enlightening and scary. So I wouldn't be surprised. And again, I never make predictions because I absolutely do not know, nobody does, what is going to happen, when and why, but I wouldn't be surprised sometime in the next chunk of some amount of years to get back to here when we just have these reversions to the mean. Now we see why long-term investors stress the reversion to the mean. It reminds me of the growth bulls right now going all in, while the value crowd is biding their time. I prefer a nice mix of growth and value in all markets. Buy the relative dip by sticking to the system's target allocations with new contributions. But let's get back on topic, the size factor. We'll jump over to Portfolio Visualizer to pull in a more comprehensive dataset. We're out on Portfolio Visualizer, and we're under the backtest asset class allocation. So I pulled up 3 portfolios here. We have US small cap value, that's portfolio 1. And then we have US small cap as portfolio 2. And US large cap as portfolio 3, each at 100%. You can see I labeled them here. And for the settings, we are going to pull from 1972 through 2024, 53 years of data, including year to date. The portfolio starts with $10,000, and we're going to contribute $500 on a monthly basis. And the rebalance doesn't matter because it's just one asset class per portfolio and no leverage. So when we hit analyze, we can see here we pulled from the beginning of 1972 through 8/20/2024. I scroll down to the performance summary section, and I'm honestly still picking my jaw up from the floor. I run these real time with you guys, and I don't script any screen shares, but holy cow. So starting with $10,000 and putting in $500 a month, and I guess 53 years is a long time to cost average in $500 per month, but 47 million for small cap value to 22 million for small cap and 18 million for the S&P 500 or large cap. Now this I could somewhat see even with the recent bull run for large cap, but hello? Like, is this thing working? 47 million compared to 18 million? Mr. Buffett, we need to have a word. And I'll get more into the returns down below. I do want to look. So best year is the highest for the small caps. That's not surprising. The worst year being the worst for large cap is a bit perplexing. And with the ratios, the Sharpe and Sortino, you want these higher to have better risk adjusted returns. That doesn't surprise me at all that small cap value has the highest Sharpe and Sortino. I'm down here in the trailing returns, and man, I knew that small cap value was better. I've read these stats for years and years and years with all the books that I read, but just seeing that on paper with it being, what, triple, almost triple, is just mind-blowing. Anyway, I'm still getting over it. I'm dazed and confused. For the annualized returns, so this doesn't care about the dollar cost average in, it just shows the average return over certain time periods. For the last year, and we knew this, large cap has dominated 22% to 16 for value and 13 for straight small. And then the last 3 years, you have the large cap with an annualized return of 9.4% compared to 7.2 and 3. In the last 5 years, large cap has reigned supreme again at 14.8 to small cap values 10.7 and small caps 9.5. And then we look at the whole decade, we have large cap just dominating by 3% and change. And those compounding results will be unreal. As we saw the other way around, we'll get to that. Small cap has actually beat small cap value. They're basically tied at 9.2%. In the full 53 years and change, small cap value 13.61% to small caps 11.49 and large caps 10.71. That's incredible. That's a big difference right there over a lot of years. Wowzer. So small cap value has been great, and small cap has also been better than large cap over a 50 plus year sample. That's hard to say that's fluky. Okay, and as promised, we're going to slice out those booming 9 years that supposedly made the difference with small cap to see if the factor is quote unquote dead or still alive, to that article's point. So now we're only looking from the beginning of 84 through 2024. So still over 40 years, but it's a lot less. And I bet the numbers are gonna be a lot smaller. Let's check it out. Down to the performance summary, you can see the balances, man, compound is crazy. We're still putting in that $500 a month and starting at 10,000, but you slice away those years and wild things happen. Small cap value is still ahead of large cap, which is pretty impressive when you take away the quote unquote only advantage it had those 9 years to the article's point. And it's including large cap's recent domination still. But you can see large cap has been a better play than small cap by a pretty significant margin over the last 40 or so years. And we don't need to look at all these returns, of course, are going to be the same for the recent years. But with the full here, you have large cap at 11.41%, small value ahead of it, as we saw with the total amount, at 11.9%, so about 0.5% better. And then just over 1% worse than large cap would be small cap without the value element at 10.4%. So it's a different picture. That article brought up a pretty good point, but the next point is we saw those windows of runs. Is it going to be small cap for another decade or so? In the near future, who knows? That data set is eye-opening, but I'm still not jumping into small cap ETFs quite yet. I'll explain myself more in a bit, but before that, let's check out some of these small cap ETFs. Specific ETF examples. Small cap ETFs have fallen well short of the S&P 500 within the last decade, but we can still see how they've performed relative to one another. Let's do just that over on Seeking Alpha. Out on Seeking Alpha, I started out with AVUV, which is the best overall small cap value ETF I found during my research. And I'll explain the field here. So right now we're on year to date, just for the duration. We are looking at total returns, dividends included. We have AVUV and VBR. These are both small cap value ETFs. And then this VIOO is the S&P 600 index. The V2 is the Russell 2000 index. And then we want to see how it compares to the market. And again, we know the market, or the S&P 500, I should say, has been better in the last decade, but just for perspective, I'll put it here. Really, we want to see these small cap values against the indices. I would say the S&P 600 and the Russell 2000 are universally the competition. And I say that with quotes right now, like it's what the funds, individual funds, are trying to compare themselves against, much like the S&P 500 in the large cap world. So year to date, AVUV is actually down the most. It's at positive 4.6%. And it looks like the winner will be the Vanguard small cap value at 8.31. And then the Russell 2000, this is interesting, has actually been better at 8 to 5.3. Now I've read a lot about how and why the S&P 600 is better. And I think we'll find that as we zoom out. So when we look at one full year, we have basically a three-way tie. The Vanguard small value is still the best. And then it looks like the Russell 2000 is just ahead of AVUV and the S&P 600. When we zoom it out 3 years here, okay, now we're getting a little, wow, that's crazy how bad the Russell 2000's been. When we zoom out, we have the Russell 2000 at 2.69%, not nice. And the other index at 8.56%. And now these ones have gone bonkers here. We have AVUV at 33% positive. It's actually outperformed the market, which is wild, all things considered, which is 31%. And the Vanguard small value has done pretty well at 20.33%. Now, when we zoom out 5 years, and this is the furthest we can go with AVUV, it just, in fact, it doesn't quite have 5 years. It's missing a little bit, but it's close enough. So it's at a little disadvantage. It's up 100.6% to the market's 108. So they're probably about tied if you gave it those few extra days. That's impressive in the recent market. And the small cap value from Vanguard is outperforming both of the indices at 72.4%. The S&P 600 is 61.2, which is ahead of the Russell 2000, which I'm used to seeing in almost every backtest I've done over a lot of years, at 54%. And then when we zoom out 10 years, and again, this doesn't count. You can see it's a baby fund. In fact, let's just get rid of it to save confusion. Zooming out 10 years, we have the small cap value falling short of the S&P 600, but outperforming the Russell 2000. And then of course the market has just obliterated all of them. Makes you wonder what AVUV would be if it existed the full 10 years. Who knows? I think I'm going to make a video soon about AVUV and some of the other best small cap value ETFs, just to give it a little more exposure, because this fund has been particularly dominant in most time periods when I was conducting my research for this. And this is one I've been following for a while, but I had not actively compared it to all of its peers. It's just been one I've been tracking in a vacuum. So it hasn't been doing as well as some of my heavy hitters that I have. You know, it's been a growth decade. But I think this will be a good one and a fairly timely video to give exposure to this one. We might be looking at a major reversion to the mean again. I've been keeping my eye on AVUV for over a year now. I think it's a great small cap ETF, and it may make sense to jump in eventually. But it doesn't quite fit in with my current investing strategy. Let's talk more about that. My point of view. I prefer the S&P 500 as my primary index and benchmark for my investments. Some of this could be recency bias, but I also understand well how the reversion to the mean has played itself out over many decades. The real reason is that the S&P 500 has a lower ceiling and a higher floor. This fits better with my portfolio composition. I choose SCHD over having bond exposure, and I also tilt towards tech within my growth section. My long-term strategy calls for a nice slice of VU to balance out my risk. But I'm not gonna lie about it. I have been considering adding AVUV lately, even before researching for this video. I'm torn because I do think that large cap companies have some advantages that will persist moving forward in today's market, but the reversion to the mean always has a way of wiggling back in. If I add AVUV to the mix, you'll be the first to know. Well, you may be the second to know. My channel members will know the day it happens as I share my moves in real time with channel member posts. And speaking of my awesome channel members, we had 3 new ones this week. I'd like to give a huge shout out to SkyTech, Michael, and Iris for joining the channel membership. And of course, a huge shout out to all of you that have been here all along. I hope you're enjoying the channel perks, and I thank you so much for the support. I plan to improve the value of this channel membership as the months roll on. Check out one of these 2 videos to continue down that path to financial freedom. Anyone, and I mean anyone, is smart enough to make it with a solid system. Thanks for watching, and I will see you here next Sunday. Deuces.